Oil is up 3.5% as concern grows over the Israel-Iran conflict. Stocks are down, also due to weak US economic data. The Bank of Japan holds amid tariff uncertainty, and Australian consumers are expecting higher inflation as global tensions rise. That's coming up in our 5 Things in 5 Minutes on Wednesday, June the 18th. And then in our deep dive interview, ANZ senior economist Matthew Galt explains why New Zealand's housing market is struggling to gain momentum even as interest rates fall.
Interest rates don't seem to have fallen enough as yet to really move the housing market into a position of strength. And given the state of the economy, we expect that interest rates will have to come down steadily further.
But first in 5 and 5 with ANZ. I'm Alex Tarrant in for Bernard Hickey. Oil prices rose around 3.5% and stocks fell again on renewed concern about the Israel-Iran conflict. That wasn't the only factor pushing stocks down. US retail sales were weak in May, down 0.9%, as was industrial production, down 0.2%. Housing market sentiment was also weak. ANZ head of G3 Economics, Brian Martin, says the US economy is slowing down.
However, the numbers are not weak enough to suggest that the economy is teetering towards recession. When you look at the labour market still being strong, what this data is telling me is that consumers are just reining in their belts. They're tightening. They're uncertain about the outlook. They're uncertain about the impact of tariffs. And they're choosing, therefore, to raise their savings rates in the short run rather than spend. We're looking for domestic demand growth to slow in the second and third quarters before it will get some support in the final stages of this year.
At 4 a.m. Sydney-Melbourne time, the S&P 500 was down 0.83%. The 10-year US Treasury yield was down 6 basis points at 4.39%. The gold price was down 0.25% at $3,408 an ounce, while West Texas Intermediate futures were up 3.5% at $74.31 a barrel. The US dollar index was up 0.62%. The Aussie dollar was down 0.87% at 64.78 US cents, while the Kiwi was down 0.64% at 60.21 US cents. Number 2. Eyes are now on the US Fed's interest rate call and commentary tomorrow. Brian says no change is expected, but he's looking for FOMC member views on where rates are headed.
We do expect that the summary of economic projections that will be updated will continue to show that the FOMC expects the impact of tariffs to be transitory and that the bias of monetary policy remains towards lower interest rates in the future. An uncertainty for markets in the short term is, will the dot plot, the median expectation of FOMC committee members, look for 1 cut or for 2 cuts this year? All FOMC members are sounding cautious. So the likelihood is that the message could be is that they are going to continue to proceed with caution, and there is a risk that the dot plot could show a median expectation of only 125 basis point rate cut in the second half of this year.
Number 3. The Bank of Japan left its policy rate unchanged at 0.5% and reduced purchases of government bonds as expected. ANZ international economist Tom Kenny says the BOJ wants to keep normalising policy but is looking for how global tariffs affect inflation.
There is an expectation that the uptrend in core inflation should return later this year as labour market conditions are historically very tight. The later said that the Bank of Japan will continue to normalise its rate policy should activity and inflation evolve as per their forecasts. We maintain our view of another 25 basis point hike in October and again in April 26. The risk to our view is the hiking gets pushed back.
Number 4. Initial news of the Israel-Iran conflict may have fed into the final days of ANZ Roy Morgan Australian Consumer Confidence data collection last week. Headline confidence was down 1.3 points to 85.4, below the 2025 average. Here's ANZ economist Sophia Ngala.
Escalating geopolitical uncertainty may have also led to a rise in weekly inflation expectations, as consumers might expect an increase in oil prices, which could pass on to higher petrol prices. We've also seen that recent domestic data has been sluggish. We saw evidence pointing to a softer outlook for the business sector, already following the weak GDP print for Q1 in the week prior.
Number 5. Monthly price data covering nearly 50% of New Zealand's CPI basket fell 0.6% in May, close to ANZ researchers' expectations. ANZ senior economist Miles Workman says sharp declines in airfares led the drop. Rents and petrol prices were also weaker than expected, with food prices a bit stronger.
Our current non-tradable inflation forecast is 1% quarter on quarter. That's quite a bit stronger than the Reserve Bank's May MPS forecast of 0.7% quarter on quarter. And I would say that the SPI data are landing somewhere in the middle of those two. I would say the selected price indices present just a little bit of upside risk to the Reserve Bank's non-tradable inflation forecast. That suggests that perhaps they may continue to tread cautiously as they remove monetary restriction and try and get monetary conditions to a more neutral setting.
Miles Workman there. Now in our deep dive interview, ANZ senior economist Matthew Galt looks at what's holding New Zealand's housing market from picking up as interest rates fall.
We saw a very small 0.1% increase for the month of May, which sort of continued the trend of very small monthly increases that we had seen in the previous 6 months, but arguably at the weaker end, with sales down as well. We saw a slight drop in Auckland prices after, again, 6 months of increases there. So overall, this May data was at the weaker end and shows the housing market largely going sideways rather than moving decisively up or down.
What are we seeing with those sales volumes and also the days it takes to sell, and how do they sit versus historical trends? Interested in what's sitting behind those sales volumes at the moment.
We saw sales volumes lift over the last couple of years from quite low levels when interest rates were very high, but they've seemed to be settling largely around their long-term historical average rather than going above. And with days to sell, it's steady around 46, which is a bit longer than its long-term historical average of about 40. So overall, this shows the housing market having moved up from a weak point a couple of years ago, but again, largely tracking sideways rather than pointing to a lot of strength.
Talk us through how housing inventory levels in New Zealand are really affecting the housing market at the moment. How's that affecting prices?
We've seen very high inventories recently, so as interest rates fell and sales volumes lifted, we saw a matching increase in new listings from people who had held on to property as prices had declined and came forward to sell it. So we've got inventories still around a 15-year high, pretty steady at that level, and that's giving buyers plenty of choice, so keeping price tension reasonably contained for the moment.
Is there a point when these rate cuts from the RBNZ will be more of a driver in terms of housing market direction, or is, say, the labour market still a key factor here?
Both are really important. So we've seen the housing market shift from a very weak point a couple of years ago when interest rates were at their high point to more of a state that's closer to its historical average, and falling interest rates will have been a large part of that. But at the same time, we've seen a very subdued domestic economy with the weak labour market figures and weak activity figures actually just in the last month or two. So interest rates don't seem to have fallen enough as yet to really move the housing market into a position of strength. And given the state of the economy, we expect that interest rates will have to come down steadily further towards 2.5%. The timing's a bit up in the air with the Reserve Bank's recent comments, but we think more support will be needed to really get the economy back on an even keel.
Your current forecasts for the housing market, how do you feel about them following this latest set of data?
We see a touch of downside risk to our current forecast, which has house prices ending the year up 4.5% and up 5.5% next year. That was based on an acceleration in house prices through the second half of the year, and we're yet to really see that emerge. So the balance of risk is probably towards the downside for our current house price forecast.
Matthew Galt there. I'm Alex Tarrant in for Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, June the 18th. Catch you tomorrow with the FOMC rate decision.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.